welcome everybody. It's nice to be here. Thank you all for attending. It looks like we're getting close to wrapping up Equity Crowdfunding Week. It's been a dynamic week with lots of opportunities, and I want to commend the Startup Starter team for making this all happen, because I know that it's been a challenge and lots of opportunities. So good job to the team, and I guess we can just start in here. My name is Len Lanzi. I am the Managing Director of the Pre-Accelerator program at Stubbs, Alderton, and Markleys. We are a full-service law firm located here in the Los Angeles area. And the Pre-Accelerator program is a division of the law firm. I think we're the only law firm in the country that has an accelerator program. And we focus on pre-revenue tech startups and help them get their feet on the ground. And the timeliness of crowdfunding is always of interest to our portfolio companies and to the people that apply. So I'm happy to share some of the experiences that we've had at the Pre-Accelerator program and working with the crowd. So that's who I am. William, why don't you introduce yourself?
Perfect. Thanks, Len. Excuse me. So William Stringer, founder of Chisos, managing partner at Chisos Capital. We invest in people, in individuals. So we've designed unique investment terms to provide early stage capital to individuals that are starting businesses. We're kind of coming in before angels, before venture capital. You can kind of think of us as friends and family capital. Our unique terms are a convertible income share agreement, which is kind of a debt equity hybrid instrument that really allows individuals to leverage their future earning potential to raise capital. So we've invested in 15 companies to date. We've also built out a automated and semi-automated application process that starts online and is open to really anyone in the United States. So yeah, that's what we do. And kind of additionally, we are wrapping up our own campaign, our own crowdfunding campaign on WeFunder. That'll be wrapping up next Friday. And so we sit in a unique position where we're investors, but we're also raising capital on using Reg CF. So we can kind of see both sides of the CF marketplace. So excellent. Yeah, that's Chisos.
Thanks, William. Oscar, why don't you introduce yourself?
Well, I'm Oscar. There we go. My name is Oscar Jofre. I'm one of the co-founders of Core Connects. We have built an all-in-one platform end-to-end for the Reg CF, Reg A, and Reg D world. And most of our time is spent advocating for the sector so we can keep growing it, so we can keep expanding it, never losing sight of why we're here, which is the everyday investor who we help democratize and participate.
Super. Well, welcome. I'd like to start off this morning with just kind of setting the table. And I was reading an article that I thought was very pertinent to our discussion today as we talk about starting a company with the intent of funding it either through the private markets or the crowd or however we want to do that. But here's, and this is from Fundera and some statistics on startup funding. 77% of small businesses rely on personal savings for their initial funding of companies. 33% of small businesses start out with less than $5,000 in funding. Only 5 out of 100 companies raise venture capital. 5 out of 100. And if you take that a step further, those that actually get a funding round of venture capital, there's a 9% or less than a 9% success rate that they will actually end up building an enterprise. Startups with 2 co-founders have raised 30% more capital than they would if they were only one founder. I think that's a really instructive statistic. So just using that as a basis of starting, when I look at early stage pre-revenue startups, these are the things that come up. How have you funded yourself so far? And what does that friends and family round look like? And that varies. That varies by startups. That varies by founders. If you're a serial entrepreneur, this is a non-issue because typically you have personal capital that you can start with, most likely from your last enterprise. In most of the cases that I see, I'm not working with serial entrepreneurs. I'm working with first-time entrepreneurs, people who have an idea, people looking for funding. They've maxed out their credit cards. They've mortgaged their house. They've gone to friends and family. And now they're coming and saying, we've spent all the money that we've raised, whether that be $25,000 or $5,000 or $150,000. And now we need to raise money, but we don't have an MVP. Or we haven't done a market validation. So what do we do? And what are the solutions? And I think what this week has shown is that there are other solutions than going to a VC fund and asking, begging, cajoling for money, because there are, crowdfunding has opened up this opportunity for more businesses to go out and raise dollars, as we've heard all week. So any comments on any of those kind of foundational statistics to start with? Oscar?
Yes, thank you. So, because I've been involved with this, it's amazing. I had to really reflect today. It's going to be the 12th year, and I'm excited. Look, the energy I have towards it today is the same I had then. And I remember 12 years ago, or even when it got launched, people were using words like, this is an alternative way of raising capital. And what the statistics are showing us is that there is always going to be a pocket of companies looking for capital at different stages, whether it's early stage seed and all that. But the measurement that we measure the success is where we are wrong. And this is the part that I think for entrepreneurs listening in, the measurement that everybody strives to is, if you don't get venture capital, it feels like, oh, you know what, I'm going to do crowdfunding because that's the only other option. And in fact, we are finally telling you today that your capital, whether it's money, whether it's venture capital or this money, is equally the same. And all you're really doing is like any smart business. If you see a market and you go, okay, there's 100, potential targets, and there's one market there that only represents 5%, and there's an open market 95%, of course you're going to go after the greater market. And I think that's the way you got to look at it. There's 95% of the market open for you, whether you want to raise $10,000. I still have memories of the company who raised $10,000 a few years back. This lady did it in Republic, and she only wanted it to make dresses, to buy sewing machines to make dresses. That's what the Jobs Act was for. That's right there. It wasn't that the bank turned her down. It's just that here was a greater chance. You already knew there it was going to get narrow. So it's almost like entrepreneurs. We get told that you got to go through that narrow gap so you can get told no. Right. So and it's funny, you said 5%. The statistics we're seeing in angel investing on the overall scope, it's 0.00055. So it's even more narrow. So where does that money come from? So I think we got to turn the conversation around to where is the money? Where's the largest pocket of it? And readdress the mentality of how we view it, because will change the statistics of numbers that we're seeing.
And it also changes how your approach to that money is too, because if you're going 100%. After VC funds, venture funds at the pre-seed level, the amount of hoops that you have to jump through in order to get even to the introduction of that venture partner to make your presentation is extraordinary, and it's an extraordinary lift.
Agreed.
And I think CF funding has democratized that and made it much easier. And there's a lot of different ways to do it. There's many, as we've heard all week, there's many different platforms. William, you have a different way of doing it. And, what are some of I think it's too early to say that you've had successes in this because you just kind of launched this enterprise, but what are your opinions on just how we've set the table so far?
Yeah, I think you were kind of giving my pitch when you were reading out those stats, and just the fact that there's all of these entrepreneurs out there, and the holy grail that everybody worships from is the venture capital world. That's what's in the news. Everyone's fundraising, everyone's exits, everyone sees venture capital, but there's increasingly more and more options to raise capital today. And I think the efforts of Startup Starter and Equity Crowdfunding Week and all of the CF platforms, they're doing a good job of helping entrepreneurs see that there's more options out there. Obviously, we have an option at Chisos that is complementary. Honestly, there's a few of our portfolio companies that we've invested in very early on that we've then pushed towards equity crowdfunding because, various reasons. Either maybe they don't quite have traction yet, or maybe they are growing at a little bit slower pace than venture capitalists would like to see, or maybe their market is a little bit smaller than venture capitalists would like to see. Whole host of reasons why venture capital might not be the right path to go down. And increasingly, there's more options. If you have traction, you can look at revenue-based financing, you can look at, PIPE, all sorts of things. And now crowdfunding, as it's growing, is an excellent option for that entrepreneur to, activate their community, or, maybe their friends and family that aren't accredited investors to get off the ground and really get started.
And I want to jump on something that Oscar said, that 95% of the money that's out there, it seems like it would be a lot easier to go after the bigger bucket or bigger pool than to try and contain yourself into one avenue of fundraising, whether that being venture capital. And they're not mutually exclusive. I think one of the challenges a lot of startups have is they think it's mutually exclusive. That, oh my gosh, if I raise venture capital, I can't do a CF funding, or I can't, I can't raise capital from a broader group of people than just a fund. Or if I go out and do CF funding, that's going to preclude me from going to venture capital later on and do a subsequent round. And they're not mutually exclusive. They work hand in hand. And I'll illustrate a company without naming the company that's in my portfolio because I didn't get permission to talk about them. But they worked with a very early stage accelerator. They had some capital put in by that accelerator, and they were introduced to Microventures, a crowdfunding platform. And they went out and raised $112,000 first time out on the Microventures platform. And that gave them enough money to do some development and to get to their MVP. And they went out, raised a little bit more capital from a venture funder, and then they did another second CF funding and raised another $120,000. What they found is if they can do that every couple of months, when they need capital to go out to the crowd, they're finding a marketplace to do that. And that money's not as expensive as it would be if they were getting it from VC funding. You got to look at the expense of money and how much money you spend to go raise that capital, and then how much is that capital actually going to cost you down the line, and giving up equity or shares. So I think that there's lots of ways to skin this cat, and from an accelerator program, we look at all ways of raising money, not just venture capital, because it's not the panacea for everybody. One of the things venture needs to do is de-risk that investment. And how do they de-risk that investment? And especially at the very early stage, it's hard to de-risk something that doesn't exist. So you're de-risking it on people. And so you really have to trust the people. I think one of the challenges in CF funding is how is that de-risked? And what, if anybody just comes onto the platform, how do you know that the folks that are actually going to run that company are going to be able to execute? Oscar, what are your thoughts on that?
But that it's a good question, but it's a risk that even everybody takes. The only difference is that in the VC world, obviously the venture capital gets on the board and provides a little bit of guidance and mentorship. But I see a lot of platforms already doing that as well. I think we have to take the approach that I'm a company admit its regulatory obligations, not all of them are going to make it. I mean, we're fooling ourselves to think it's going to be 100%, but I think there's enough of an ecosystem now surrounding itself to make sure the platforms are finally taking on the responsibility to make sure that companies, not only when they raise the capital, now hey, okay, you need to plan for this. After you raise your capital, you're going to need to do this. You're going to need to plan for that. Because, you went from a company with 5 shareholders, now you got 4,000, you got 5,000 shareholders, which is a great thing because which company would not want to have 5,000 customers or 5,000 brand ambassadors or 5,000 people that will go out and tell the whole world what it is they're doing. So I really believe that we're now maturing to that stage. We went from, in 2012, all we heard was we were going to be filled with fraud. In 2015, we went live. The industry went live. There was no fraud. Why? Because, there was a filing that needed to be done with the SEC, and that still needs to be there. Now, if you want to raise more than $1 million, the company needs to file, audited financial statement, which is done with an auditor under GAAP. So, if someone's going to commit fraud, you got to get a lawyer involved, an auditor, and there's a lot of pieces. And there's a new player now that has emerged in the crowdfunding space that in the early days, they dismissed it. And they were the same. They didn't help the industry because of them dismissing it as, it's small kiddies. It's like, who wants to do that crowdfunding stuff where people give away products? And that's the broker-dealer. The FINRA broker-dealer has woken up. And, my favorite saying for 2021 to everyone is, be careful what you wish for. So, everybody wanted the increase in Reg CF from 1 million to 5. Now you got it. And people go, that's hooray, hooray. But you just woke up someone that you weren't ready for. And that is, you woke up the broker-dealer because now you're going after their turf. And now they're coming in. And their value proposition is even stronger than the funding platforms because they are a broker-dealer. They can pay commissions, they can provide advice. And so now we got another advocate to the table that we didn't have before. And so when you start adding, when the ecosystem keeps expanding, it just keeps reinforcing the entire sector. And I believe that because of that, the same way venture capitalists take on investment and they have an ecosystem of participants that are going to help nurture the company, it's going to happen the same way here. Not every company is going to take it up. I'd be fooling you if I told you if that was going to be the case. But I believe the ones that want to grow and expand will be definitely open to it. Because if you heard my earlier comment today, I mentioned that this opportunity comes with a greater responsibility. You get the opportunity to sell to that 95% of the market on your terms. That means you get your valuation. So you don't have to cry. You don't have to complain. You own your company. Fantastic. You control it. Now that you control it, your responsibility is even greater because now you didn't want to give that up before and let them do it. Now you have to do it. And so for that, then you're going to need to learn to be transparent. Companies are transparent when they're raising their capital. Well, you're going to need to be transparent right after you're done raising your cap. It doesn't end there. It's a continuation. So this is part of the evolution of our market. If you go back in the early days of venture capital, it was the same way. They were making investment and they took a hands off and no, that's not working. We got to get in. And now some VCs, they got an HR team, they got a sales team, they got a tech team. You feel like, so what am I bringing to the table?
That's right.
So, but I think it's, I just think we are evolving at such a great pace right now. And the crowdfunding, the industry itself is getting such tremendous support from a larger audience now that wasn't there before. And that's a positive. That's reinforcing the sector. And we're going to need more than ever. We're going to need great accelerators. We're going to need accelerators. We're going to need incubators to help that company that wants to raise $10,000 or $50,000, whatever it is, or $1 million. So it's the next level that I see coming in the sector.
Len,
Well,
question for you. So
yeah.
as you're working with these, pre-revenue companies or very early companies, how do you help them think about which avenue to raise capital? Venture versus crowdfunding versus other.
Crowdfunding. So some of it has to do with the industry and the type of company that it is. I think crowdfunding is suited well for products and widgets and things. Maybe less suited for ethereal selling of bits or service industry type things. It really comes down to is that founder, that entrepreneur, a passionate communicator that can communicate a message to inspire people to want to invest in them. And that's true in front of a venture capital partner as much as it is doing a video and putting it out on a platform and asking people to invest money in. So it really depends on their ability to communicate their message, what that problem is. Is it big enough? Does it touch enough people? One of the things I love about crowdfunding is it's a true market validation of what people are trying to do. And, we talk about doing market validation and making sure that there's a market for what you're selling. And when you go out to the crowd with that message, you'll find very quickly whether people believe that what you have is actually a solution to a problem. And so that's one of the considerations that we take, or I take in working with portfolio companies on, okay, when we start capital mapping for you, these are the opportunities, these are the things that can help you grow your company. Let's consider all of them and move forward. We've done a couple of CF programs here at the Precelerator this year because the portfolio companies are interested in it, and they are frustrated by the many hoops that angel groups are putting them through, or that venture partners are putting them through in order to even get in front of them. By raising the bar every time they go back. Well, you need this traction. Now you need this traction. And with the crowd, you don't have to do that. You go out once and the crowd is going to tell you whether you have a good enough program that they want to fund. So I think that's true market validation. And that's one of the reasons why I like it. I think one of the cautions I'll throw out there is that founder, is that CEO of a startup prepared once they raise that money for those 4,000 investors? And now what do they do with them? How do they communicate with them? What is their fiduciary responsibility back to them? And are we training people to be ready for that? It's easy to train them to be ready for 2 or 3 VCs that may come onto their board. But all of a sudden, when your cap table shows 4,000 or 5,000 people, now you need someone in charge of investor relations. And is a startup ready for that? So I think that's one of the things that I caution people out, is to make sure you have the infrastructure once you do raise the money, because you have to have a big enough boat to catch the fish in. And if you're in a rowboat and you land a whale, you're going to sink. So I think that analogy suits this discussion. So thoughts?
Yeah,
Oscar?
I was just going to go there. I was listening to you earlier, and I was saying, let's not forget the part, what happens when you raise your money, which you will, and a lot of them are not ready. So God, it goes way back a few years. I'm rewriting the book, but it's called Equity Crowdfunding 101. I wrote 2 chapters in there about, and I got called on it by the VC community, where I said, turn shareholders, think of them as customers, and turn them into ambassadors. And, I put it back, because they were saying, who on earth would want 5,000 shareholders? And I say, well, when I come to your door looking for money, the first thing you ask me is how many customers I have. So what if I brought 5,000? I mean, what is the difference, right? I think, so that's the value proposition. Everybody gets that part. But what they tend to forget, this is where right now we need to hurry on this. What a lot of companies are forgetting, you didn't create a plan after you raise your money, because now you have those 5,000 customers or ambassadors. So there's some great companies that have adopted the framework that I introduced, companies like Brewdog Breweries, there's companies like Legion M, and there's a few others. They don't call them shareholders. One calls them equity punks, the other one calls them legionnaires. our company, we call them gladiators. They're coming on board with us to embrace the market, where they're part of the journey. They're going to live and breathe my pain. No longer this shareholders over here and the company over there. If we do that, we're going back to 2008 financial crisis, because that's exactly what happened. Investors were put in one bucket, and the guys with the money would said, "Oh, you know what? We'll just take our money and we'll come right back again." While everybody else lost their homes and all that. The Jobs Act was created to make sure that wouldn't happen again. So I don't know where we're going to get that. I've been looking for companies who specialize. I don't know if we're going to call it investor relations, because the only thing I don't like about that term, it's coming from the connotation of the publicly traded world, which in their world is, I become an IR person. I'm compensated if I take the stock from 10 cents to 50 cents and I get options, and voila, and they don't know the shareholders by name. I described that earlier in another call. I said the difference between a private company and a public company is very simple. In a public company, the CEO and management board of directors look at the cap table and they see a number: 88,700,000 shares outstanding. That's a public. And a private, they see 88 million and all that, but they see John, Linda, Harry, Smith. They see every single shareholder by line item who owns the equity in their company. So that responsibility, you can't say you don't know who they are. So you need to have a plan, and people need to start looking at these individuals. There's a great opportunity out there, and I'm calling people out on this. If you have the mindset, you have the mindset of helping community development, you have the mindset of what it means to take care, this is what companies need. And make no mistake, companies, anybody who's raising money, 100 shareholders or more, you need to bring a person like that in, even as on a part-time basis, to give you a strategy. To your point, Len, if we don't do that, you need money the next time around to be, well, we didn't hear from you for the last 6 months. What's been going on?
That's right. Why would I give you more?
Exactly.
And I think it really does start, CF funding, venture capital funding, those are all tactics. You need to have a strategy before you build your tactics. And so having a strategy that takes you out from beginning to end, and having that vision is very, very important as you set that table. So, I'll use the setting of the table and feeding a dinner, right? You have your appetizer, you have your main course, you have your pasta course, you have your salad, and you have your dessert, and you plan a menu. And when you're building your company and you're building your capital strategy, you have to plan your menu, and you have to know at each point when you're going to deliver that, and how you're going to respond to those people to make that next course as appetizing as the first course was. So that is really the magic of how this all works. But you need to go in with a strategy, because once you raise that money, yes, you have a responsibility back to those people that made an investment into you. And that responsibility is communication, to treat them as customers, not just investors. I really believe that's important, Oscar. And it goes back to pre-equity crowdfunding, and just going back to the Kickstarter campaigns that people had.
Yeah. Going back to the basics. And
there's no difference. There's no difference
whatsoever,
other than one is equity and one is not equity. But Kickstarter campaigns were great for market validation and building customer bases, and same thing with CF funding. So don't forget that. I think that's a big piece of it. William, we're dominating the conversation over you, so speak up.
No, it's good conversation. Just wanted to kind of give an example of what we're doing. So, right now, like I said, we're wrapping up our crowdfunding next week. We've got over 400 investors. And for us, a big reason why we did the crowdfund was to get those 400, 500 investors in our ecosystem, financially incentivized, bought into our company to help us succeed, and for us specifically to help our portfolio companies succeed. And so what we've set up is a number of different databases where investors in our crowd campaign can go in and say, hey, I'm an investor, I'm a service provider, I'm a mentor, I'm an advisor, and I'm interested in helping your portfolio companies. And so that's been a great tool for us to activate our investors and get them involved in what we're doing, as well as help our portfolio companies. So one example I gave earlier in the week was, we had a portfolio company that came to us and said, hey, trying to find a UX UI designer. We went out, blasted it to our network and said, which includes our investors in the crowdfunding campaign, and said, hey, portfolio company looking for this. A week later, we got 5, 6, 7 different options back that we presented to the portfolio company, and then they made a hire. That couldn't have happened without that army of investors that were willing and able to help us and help our portfolio companies. So that's just, one example of what we're doing. And then the other piece on kind of activating and getting your investors involved, I mentioned this early in the week as well, but I think the CF world and any founders that raise using CF can take a page out of the playbook from what's going on in the crypto world right now. So the NFT craze is, got some flaws and things going on that, will work itself out. But what they're doing really well is building these communities where people go in, they buy an NFT, and then they're part of the community. And that community is building games. It's building, metaverse experiences. They're all working together to create value. And I think there's some parallels there between, the Reg CF investors and, having 500, 600 people on your cap table, and working together to create value versus just being passive on the cap table.
Agreed. But with the only cautionary tale that we just for the sake of, for your protection and all ours, we have to indicate that, there is a large portion of NFTs today that are proceeding in the market with the wrong assumption that what they're doing is not a security. It is a security. So what
100%.
You're talking about is a registered, regulated NFT security. And I agree with you 100%.
Lots of securities laws being broken in that world. I'm
No,
just
I
making
know.
parallel
I just thought I'd
on the
mention it
community
because
aspect of it.
there's a lot of chatter about NFTs right now. It's supposed to be the game changer, and it's not. It's just a very different variation of digital securities. It's the same thing, but I understand it. But I caution people thinking that it. It's funny. I'm an entrepreneur, but I also respect compliance. And we have a new commissioner, as we all know, right? And he's the type of person, if you saw it, there was a picture, there's a gentleman ringing the bell at the New York Stock Exchange, and this individual served a subpoena right there. That's the kind of commissioner we have today. He is not going to allow, which we do need the market to clean up, but it's like any market. There's always going to be those individuals that are going to try to utilize it for non-compliantly. So, but it's
and that reminds me of what crowdfunding looked like back in 2012 to 2015.
Yes.
Just before the Jobs Act was fully enacted, there were platforms out there trying to do this, and there were a lot of lessons learned. And actually, I applaud those efforts, because without people trying different things up front, when it actually became law, those people that were then well positioned on their platform with broker-dealer licenses, with built-in databases of investors that they could bring to the retail environment through crowdfunding, was very, very helpful. And
was, most of you probably might not know this, but that's a really great point, Len. The people that started in 2012, there were some mistakes, and we don't talk about it much, but I will tell you, there was one fraud between 2012 and 2015, one. And it was caught early enough by the SEC. It was caught so fast. This fraud occurred on AngelList and EquityNet. So I just want to make sure we're really clear. It did not happen on a registered funding platform or a broker-dealer funding platform, because there's no way that, and the fraud was beautiful. The only thing that was real was the company. That was it. The name of the company. He faked everything else, and the SEC was able to get about 90% of the money. So it taught us a lot. At that moment, the SEC was kind of saying, yes, EquityNet, we'll let you operate without a license. And now after that, all of them got their letters pulled. So from then on, it was a registered funding portal or a registered broker-dealer. There was no more gray. That's what happens with gray. Gray means that if nobody's watching out for the investor, I mean, we all, I hear this a lot. This is what we're doing for companies. This is what we're doing for companies. We need to stop that narrative. I'm sorry. I think this is really important. That I think that narrative is, we're all saying that, but we should really be saying is, what can I do to that investor? We need to help them. Remember, they're putting in $500, maybe $1,000. That may not be a lot, but that's all they got, and they're willing to participate. So we really need to be focused on how can we get that money they put in to make sure they get a return. You know why? Because if they do that, they'll come back again and again and again. And that's, we need to start having that. The equation today that I see in content in the market, and our team, we brought in a research team to analyze all the content out there today, outside of King's Crowd, which Chris and the team are doing a great job. Thank you. And hopefully more like Chris will do the same. They're bringing a highlight, and they're doing some, report utilizing the First Amendment, not as a registered regulated entity. But nevertheless, at least it's for the investor. But we need a voice by the platforms in the industry to start talking about the investor, because make no mistake, if we don't start putting a voice to them or bring an education that we're there for them, like any other sector, they know how big their crowd is. The same way you got them, they're going to turn that around and utilize it coming back. And we are so close. I kid you not. I was only a week away from publishing an article, and I know the title of the article is so, like, it looks like doomsday. It's not meant to be. It's to try to get your attention. It's time to wake up. And that is we're putting retail investors, and I'm not going to use the word retail. We're taking everyday people that have not been given a chance to invest before. We're telling them in the advertising, come here. You will be able to participate directly. I mean, you listen to those words. Words are everything. Directly into my company, and you will be a shareholder. And then they put their $100 in or $200 in, and then a few days later or a couple emails later, they get an email, they sign this sub-agreement, and then they're wondering, and then they find out that, wait a minute, how come I'm not a shareholder of that company? I'm a shareholder in this company. I don't get it. So we are already making some early mistakes by putting them under SPVs and custodial, which some people said, well, Oscar, the company needs to have one shareholder in their line. Okay. So Len said it best. If your strategy to the market is to go after venture capital, and you've not raised any money before, I will give you 70% that's a good strategy for you. I think it's you narrate it, but you got to understand what you're walking into. You're walking into with a new vehicle. They're not going to go away. You're still going to be responsible. Now you got 2 legal entities, plus you got K1 returns and all that to do, but just know what you're going into. So that's one model. But if the company has already raised seed capital from other investors, or you've used the regulation before, and these investors are already being managed by one transfer agent or some form, and then all of a sudden you bring another round of financing, which here's the part you're going to love. 30% of investors reinvest again. 30%. Now that is great. Not when you do this to them. In one way, they're being managed over here. And as soon as you stick this vehicle, they're being managed over there. And now you're trying to tell them what's going on here. So I'm an advocate for the investor. 2021 and 2022, our entire thesis is about how do we get them educated what they're investing in, to start asking the questions. Our company has spent years educating people on what a safe is, what a warrant is. And people go, but it's simple. Yes, it is when you do investing every day. But it's not when people think a safe is shares in a company. It's not. And we, the transfer agent, have the bad news to tell them. And of course, we understand why it's done. Don't get me wrong. It's not done illegal. Nobody's doing anything illegal. But my point is, it's hard to go explain to them that they thought they invested this way, and then they get this other. That's called bait and switch, right? So the retail investor is a volatile investor. or the general crowd is volatile. It can turn on us at any moment. And
I would
yeah.
also add, while it's volatile, they're also uneducated and not uneducated, unsophisticated investors, right?
Correct.
And the simpler we can keep this process for the investor, the better off everybody is. Once you start complicating it, and you mentioned a couple of words like safe and warrants, those tend to be more sophisticated, opportunities or instruments to finance. And in the retail market, there's no place for that, because it's too hard to communicate to them what a special purpose vehicle is and what that means. And and like you said, in some cases that's a great strategy to use, but you need to know what it is, and you need to know what type of investors you want to go after to be part of that investment portfolio, because that may not be your retail investor going into an SPV. It might be more of a wholesale investor, or someone who's been investing in the past and understands what they're getting into and what the advantages are for them from doing that, and what the advantages are for the company. So
agreed. I always sorry, William, I didn't need to get, it's just this is a really dear subject to me, because I'm dealing with quite a bit, and I sympathize. We're actually doing a little booklet right now for investors to tell them that even though in the safe, you're not a shareholder, you're going to be converted into shares, and why it's an advantage for you. Because so you have to give them examples, right? You have to show them that if it was worth, $10, you're going to get a discount to X. And if the valuation is here, so there's a lot of things, but you're right. It's education. We can't move too quickly, that we're getting high almighty. That's the word I'm using, high almighty, that, hey, we're getting so big. Yeah, don't worry, they'll just buy it. Yeah, you keep doing that, and this is what's going to happen. It's going to fall right back at us. One thing I like about Regulation A, this is what I like about Reg A versus Reg CF. Reg A is what I call beautiful vanilla. Why? Because there's vanilla and French vanilla. Vanilla is shares, French vanilla is equity, and that's it. There's, you can do bonus shares, you can do perks, you can do all those things that you can. But what it doesn't allow you to do is put the investors in an SPV, a custodial, or any of those things. The companies are even raising greater amounts, like 75 million. So you can get the idea that the numbers are even greater. So this is the part of the education piece that I'm spending quite a bit of time. And it's good to see both your companies, like William in particular, is that you're advocating for that, right? You're advocating for that direct. And it's an interesting model that I have to admit, I've been spending time on your site just to get, because we've only been looking at it. At first, I thought you were an ILO. Have you heard of that?
I've not, no.
Oh my goodness. So I love the acronyms, right? So a while back, about a year
I'll have to
and a
do
half
some
ago,
research.
Yeah, I got approached by a group and say, Oscar, we're going to come up with this new model where investors can invest on ILOs. And I go, what the heck is that? Initial licensing offering. So basically the company's selling its revenue, and I'm going, okay. And then they were talking about where that revenue could trade. And I go, okay. I said, good. It's a security. Go, no. It's not a security because it's revenue. Yeah, but you mentioned trading.
It's a licensing deal.
Well, that's what's similar to what Pipe's doing, right? I mean, they're taking revenue streams and financing them, and then facilitating a bit of a market. So I mean, this stuff is happening. You're right. It is. They are.
And there's lots of different instruments out there that really cloud up or gunk up what a retail investor is looking at and how they get involved. And again, I'll go back to simplicity. So believe it or not, our 45 minutes allotted to us is up, if you can believe that. So before we say goodbye, Oscar, how do we get in touch with you, and what could you offer?
What could I offer? Hey, thank you for that. My name is Oscar Jofre. You can find me LinkedIn, Twitter, Facebook. I'm there. Easy, just my name. And what I offer is I'm here to provide education. We have the largest library in regulation, CFNA, and I'm here to support the initiatives what William and others are doing, including Len. That's what we're here to do. By supporting them, we have a healthy ecosystem.
Thank you very much. William?
Yep. William Stringer, LinkedIn, Twitter, Chisos Capital, LinkedIn, Twitter, website, chisos.io. If you're an entrepreneur, obviously we have one offering, one way to provide capital. You can learn more on our website. I'm also happy to chat about raising via Reg CF. I'm Republic venture partner. I'm raising currently on WeFunder. And so I know the landscape from the founder point of view. So always happy to chat and provide any advice or provide intros where I can be helpful.
Super. Thank you. And I'm Len Lanzi. I'm the managing director of the Pre-Accelerator program at Stubbs, Alton, and Marklees. I can be found on LinkedIn at Leonard Lanzi. I can be found on Twitter. I can be found at Pre-Accelerator or Stubbs, Alton, and Marklees. We are a pre-revenue, early stage tech accelerator located here in Santa Monica. We focus on the Southern California market, and we're looking for good tech founders that are looking to accelerate and take advantage of some fantastic legal services that we offer as part of our program. And with that, gentlemen, thank you all for participating today, and I look forward to working with both of you in the future.
Likewise.
Perfect.
Thanks, y'all.
Likewise.